Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. As always, guys, we got a packed show for you today. We got some data points you guys are not going to want to miss. Very important that you understand where we are in this cycle. It's going to be exciting, but it's also going to be crazy. And more elites are bailing on this market. We're going to talk about all of this in today's episode. Let's dive in.
Trade Genius.
Hey everybody, Bob, Trade Genius here. Peace, love, and Trade Genius. Spring into some savings with us right now. We got some great specials running. Market is in unprecedented areas right now. We think we got a good handle on it. Go to tradelikeagenius.com. Take advantage of our spring specials. Thanks for listening. See you later.
Bob, another financial giant is leaving the stock market. What say you?
Yeah, you ever get the thing where the TV starts going, the emergency broadcast? So we're getting not an Amber Alert, we're getting a better sell everything alert coming into the market. For the first time ever in his 40-year career as a CEO, Jamie Dimon is selling stock. Now, that is unprecedented. He's probably the most conservative guy out there, and he knows his bank is not going to fare well in this environment. So here's his disclosure, and that just puts another notch in the lipstick case, of this market. And, I don't know how many more warnings you're going to get. I don't want people here 6 months from now complaining about how the stock market sucks when you could have got out here at the top. But speaking of the top, Phil, our favorite quant, I want to give credit where credit's due here. This came from Jam Croissant's podcast that he does, that he got from, I think this is a Bloomberg or a JP Morgan. Yeah, JP Morgan. Probably why Jamie Dimon sold is that we're going in round two of the inflation rate. We talked about this before. The last 2 months, they missed to the upside. Market is desperately trying to blow this thing off because this is what they're seeing in front of them, an absolute systemic collapse in stock prices and increase in the cost of living. This is 73, 74 all over again. When people tell you, oh, hey, the stock market's tied to inflation, they're smoking dope because, averages can deceive you over time. And here's where you're going to get a huge divergence because it's going to make perfect sense when we show you this next chart. And I'll let Phil share you these next two charts with you, is that this is why being in the stocks right now, if you're a risk manager and you're listening to this, I can't believe that you're not being fired for not being able to positioning your clients into more safe assets based on these next two charts. Phil, take it away.
All right, let's swing over to the U.S. equity risk premium. This is at a 23-year low. What this means is that the way it's defined is that you're taking the S&P 500 corporate earnings yield and you're subtracting the U.S. 3-month T-bill yield, which is one of the shortest durations that you can get, but it's paying a very high yield historically. And what does that mean? What that means is that holding S&P 500 stocks, equities, your return on your investment relative to the price of those stocks and their earnings, that yield is less than what you would get holding a risk-free return in something like a 3-month T-bill, which is a very short duration. You can roll that, get your money back, whatever you want to do every 3 months. Very short duration. Not a normal situation in the markets. Historically, here on this chart, you can see where negative equity risk premiums is not a sign of where you want to be investing in the market. And on top of that, if you notice what we did into 01, we started to cascade down into more and more negative premium. Why? Because we were in a bubble. And that's what happens in a bubble. These risk premiums start to go parabolically down and finally bottom out. And then you get your spike. So when we start getting this spike in this, it's going to mean that the market has topped. Equity prices are coming down and it's going to increase basically the price to earnings ratio for equities. And this is going to start to return back into positive territory compared to what T-bills are doing. And why would T-bill yields drop? Well, because now the smart money is moving into the bond market. And that already happened with TLT. You guys saw that it broke the lows, came back over that key 88 level, right? That was all institutional money getting positioned for what's coming later in the year. Now you look and you have all of the big financial elites leaving the market in mass. So you can start to do the math. And if you think this is, by chance, no. This stuff is planned out. It's a big chess game. They want this equity risk premium to be at its lowest levels prior to recession. Why? Because you've milked the run up in equities. Now it's not an attractive price ratio anymore compared to what yields are doing across the board. And now you can go into bonds to lock in the same exact premium while bond prices start to rise. Okay. So, this is the game that they play. Now, the bigger money is going to lock in, 1-year bonds, 2-year bonds, 3-year bonds. But the point is that if your 3-month is beating the corporate earnings yield, we got a problem in terms of valuations in this market. So this market's extremely expensive, and that's what negative equity risk premiums means. And you can see where we are relative to the dot-com bubble. And as Bob and I have mentioned over and over again, many similarities to the dot-com bubble here. Now, speaking of dot-com bubble, Bob, this chart and what happened yesterday, I think you guys need to pay attention. This is the most important part of the video, maybe one of the most important segments we've done all year. So yesterday, a lot of you guys, I think Bob, you saw him in the comments too, were just saying how ridiculous that move was yesterday. For us, not so surprising because we're kind of expecting this nonsense, especially we said if NVIDIA beats earnings, this market is just going to squeeze higher. I had mentioned we had a fib target up at 51.13. We shot over that a little bit this morning. We're pulling back now and there might be some profit taking into this afternoon. But notice this chart here, guys. The composite was up nearly 3%. Now, oh, by the way, the last time the composite was up 3%, it made a new all-time high. It topped the market in March of 2020. So I think we're a little different. We can still go higher, but that's telling you that things are really starting to pop off here. But in terms of what happened yesterday and why you guys felt like it was just really ridiculous, well, it was up 3% with fewer than 55% of the issues in the Nasdaq Composite advancing. So barely more than half were advancing. That is not a measure of a healthy market. That is not a broad breadth. And there's 5 precedents, okay, only 5 precedents according to Sentiment Trader, who provided this data. And that occurred between 1999 and 2001. What happened there? We blow off top. So what does that mean going forward? All right, let's look. So if we look at the data here, okay, so you saw those little red arrows. So that's what each one of these rows represents. So from you start getting you get a couple of those readings prior to the all-time high, and then you start getting more readings after the all-time high. So basically the top 3 here are into the all-time high or just slightly after, and then the bottom 4 are as we progressed away from putting in the highs for the year. You'll notice that the first couple of weeks, no big deal. Maybe the first month, no big deal. But then it starts to turn red as we progress through. And even after, because what happens is after the market peaks and it pulls back, you'll get more of these extreme readings and you'll get a lower high push. That's why some of these 1 month and 2 months are still not red. But notice when you start to get 6 months out, 1 year out, notice how deeply red things get. And if you look from the first couple of readings, really it starts at 2 months and then 3 months out where you start getting red. So what we're saying is that kind of plays into that scenario we talked about where you could get a blow off move after March going up into April and May. And if it's a very parabolic move, I think that's your window where you're going to see potentially a blow off top, Bob. So I think this data here, it's a very rare event of what we saw. And I think we're on the clock now. We're in the final stretch of this blow off move that's been building and building and building. And we had a giant pullback in 2022. This is now that third leg out of that, breaking out of that 3-year consolidation in the market. And now we're getting into the final innings of this blow off move. And where that can go very high, higher than most people think. I think the extreme on it, Bob, might be north of S&P 500, 6,000, and Bitcoin could go to 100 plus. I would consider that an Eiffel Tower move in the making if that happens.
Yeah, and you know what? And we could be wrong, and it could have topped yesterday too. So our point is that you got to be really, really careful here. The market is very much on pins and needles here, and you just don't know what's going to be the Jenga pull to roll this thing over. But data tells us that if we can't get lower this week, and we didn't, that there's a good chance then we're going to probably have a strong end of quarter, and then who knows? The Fed may be the one in the position to create the blow up by saying they're going to start pulling rates down. And then basically all hell's going to break loose after that. So be really careful. Look, we're still long energy, consolidation to some weakness in Bitcoin in March. And I think you're going to have to play the market, day by day. The chip sector is going to be the one that's going to suffer the most when this is over. So start looking at SSG, start looking at NVDS, start scaling in over the next 60 days on those. And I think you're going to be pretty happy come the end of the year. But with that, Phil, I think we're good to go. We'll see you guys tomorrow. Let us know what other data points you want us to look at. If you want us to talk about certain sectors or certain stocks, we're happy to do it. But the data is just lining up. Look, smart money doesn't sell the day before the crash. Smart money is out, and they want you to think that they were early, okay? You don't want to be the guy at the end of the rope.
Trade Genius.